that we're working on, or previous chapter?
Actually, I'm starting with the old, but I'm going to go into the new.
Okay.
My question first is any of the old ones we need to go over.
Actually, I feel good about the first couple chapters that we've done.
Okay, good.
I don't have any specific questions. Hopefully I did okay.
Okay. Well, you know that you can click on your score in the grade book, which Chad, yours has just done this morning. And
Okay.
Once you get in there, there's a way to see my comments on the spreadsheets.
Okay.
So if you have trouble getting to those, let me know, but that'll be the case in all the homework. Just go back to the link you clicked to submit it, and you'll be able to open the document and see my comments.
You got it.
Okay, well, let's get into chapter 11. And if this brings up anything of, oh, you're mentioning something from an old chapter I never did understand, we'll stop and clear that up.
Okay.
I have the book open to chapter 11, but I've got Excel stretched out on the screen so that we can do some math problems and such. If you don't have the book, just let me know when I can project it on the screen.
I have my book open.
Okay. Everybody else with us on books, okay?
Yep.
Yeah.
Okay, just bear with me. I'm kind of turning pages in the book as I'm doing this. This may mess up your screen for a minute. Ah, there we go. Okay, I am in chapter 11, and honestly, the book compared to the assignments, the book goes into much more detail than you will need in order to accomplish the assignments.
Thank goodness.
So I'm going to go over a little bit of what you covered in the reading, but kind of paraphrasing it down, and then we'll look at what really is needed for the assignments.
Okay.
Sounds good.
Your first
formula. So
your first homework one, I believe, was question 3.
3.
So I'm going to back up, and before we even get into something like that, or like the homework, we're going to look at some of the things they're talking about in the chapter. Okay. If you're looking at debt, one of the things we're trying to figure out is, in every one of these cases, is cost of capital. Big fancy term that just means how much does it cost us to borrow or get money from some source. If you were doing this to get a car loan or to make an addition on your house, you probably are limited in your choices of where to go. The bank, maybe a financing place for a car like General Motors has Ally Financial and so on, to borrow money. Maybe it's a relative. You can go and ask for a loan. So you have to look at what would it cost me to borrow that money. And the biggest cost is usually interest. There may be some other fees that you have to pay, but those would be your cost of borrowing that money. And all else being equal, the one with the lowest interest is the one you want to go with. The one's going to cost you the least amount of money to borrow.
right.
We know if we get into the specifics of things like borrowing money from family and all the issues that might bring about, that brings into whole other kinds of costs. But in here, we can't get into the soft things like that. We have to really just crunch numbers. So we're not going to be looking at, is it smarter to do this or that based on intangible or tangible things for the company, like what will its reputation be? How will Wall Street perceive this? What will my customers think if I issue more bonds? We're going to have to just look at bonds look like they're cheaper than stock, or whatever the scenario. Loan A is better than loan B. So we're going to calculate the cost of each of the different types of ways that companies can borrow money. And one of them is debt. And notes and bonds are usually the two big ways that companies borrow money, debt. Even if they go to the bank and get a loan, that is really signing a promissory note to pay back the bank a certain amount of money that they borrowed. Those rates are usually fed right on the bank note. The bank says, I'll give you a loan, you can sign a note, but this is the interest rate you're going to have to pay me. Bonds come with a stated rate on them. The company can decide. The company issues bonds, they're just IOU notes. And they can issue bonds or notes to people. So they can borrow money from the bank and sign a note, or they can issue notes to other people. Just again, just signing a promise to pay back piece of paper called a note with an interest rate stated on it.
That's all it is?
That's really all it is. Lots of fancy legal language in it, but it is an IOU note. I tell my in-seat classes when we're talking about it, imagine third grade in the playground borrowing money, and you grab some scrap sheet paper and you wrote IOU, and you told them you'd pay them back on Thursday. And if they were really sophisticated in third grade, they asked for more money back than they've loaned to you. But that's all it really is. A bond is a little different, but got a lot of the same characteristics. A bond is in $1,000 denominations. So if you need a lot of money, millions of dollars, you have a whole stack of bonds printed up. Imagine a pad of, like a doctor gets a prescription pad. They're all pre-formatted with all the information on them, and he just rips off one and signs it when he needs it.
In $1,000 denomination.
Right.
Okay.
And so if a company needs lots of, like, millions of dollars of bonds, they're going to have a lot of bonds printed up. They're going to find separate people to loan them money. So that's one of the conveniences. They don't need to find one source to borrow $3 million. They can find a lot of sources, 3,000 different people, so each loan them $1,000. Or somebody might loan them $5,000, will rip off 5 of the bonds, sign them, and hand them to that person. It's a lot easier to find a lot of people each willing to loan us $1,000 than one person willing to risk $3 million with us.
Okay.
Right.
Bonds usually come with a stated interest rate on them and a length of time. And the length of time is long. Could be 10, 20, 30, 40 years. That's a long time for somebody to loan our company money. And it's risky when you're thinking, will this company still be around in 20 years, 30 years?
Yeah.
You've seen companies that you thought were going to last forever, and they kind of started to decline, and now we all kind of think, will Best Buy be here in 10 years, or whatever the place might be? So one of the things that can happen is that bonds can be sold. Just think about, like, when the company gives somebody a bond and says, thank you for your $1,000, here's the piece of paper. If the person's getting tired of waiting forever to get their money, they can sell it on to somebody else. Just the same way cars are sold. From Ford will sell car to a customer. That customer gets tired of having that car, sells it in the used car market to somebody else. The same thing can happen with a bond. The funny thing about bonds is that interest is paid at least once a year. But the principal, the $1,000, is only paid back at the end.
Okay.
So they don't get their $1,000 back till the end of the bond or until they sell it on to somebody else.
Depending on if it's a 20, 30, or 40-year bond.
Right? It could be a long time.
Okay.
But they will get periodic interest payments. So if the bond is an 8% bond, that's $80 a year that they'll get in interest.
Okay.
Sometimes some bonds say they'll pay twice a year. That means instead of $80 once a year, they'll give out $40 in January and in July, or some 2 points in the year. But his problem still comes back that no money is paid back to the bondholders until the end. So that's kind of different. A note is usually any amount of money, usually one person loaning the company money. So it's just a piece of paper between one person and the company. It does have an interest rate, and it's usually shorter term. Now, it still may be 5-10 years. It could be as short as 60 days. It could be any length of time, but if you looked at the typical bond and the typical note, the notes are usually shorter. But interest, let's shorten that up so we can make it fit here, and principal. Let's make our notes just a little bit wider here. So interest and principal are paid back at the same time. If the note is kind of short, like 60 days, a year, it may be that the person loans the company money, any amount of money. There's no set amount. And all of it is paid back at one time.
Okay.
So if $200 is borrowed for 1 year at 7% interest, then $214 is paid back in 1 year. All in one payment. So the differences between notes and bonds, you get periodically, you get some of your money back. If it's payments like the way you do your car loan, you're paying back some of your note, the principal, along with interest every month.
Mm-hmm.
So that is a typical note. It's between you and the bank. The bank loans you money. You've made an arrangement to pay them back, some principal, some interest every month. Companies can have that same situation, or they can have these shorter term notes that are just, let's wait till the end of the year and I'll give you everything. So we're trying to come up with a cost for them. Sometimes they're really simple. The cost of capital might be as simple as the 7%. That was what we said our note was for. So the cost of our company borrowing money on a note is 7%. A bond also has a stated rate of interest. So if we pretended our bond had an 8% interest rate, then we would say its cost of capital is 8%.
Oh, that's where that percent comes from then. Okay.
Right.
The interest rate.
Right. It's figuring out how you're going to pay the bond. And remember, those bonds are pre-printed on that stationary pad or that pad of bonds. But sometimes the world's interest rate changes. We're always trying to find people to loan us $1,000 denominations. So we've got to keep them interested. If our bond came pre-printed with 8%, but investors were able to find good bonds other places that were running 9%, they're not going to come buy our bonds or loan us money. They're not interested in 8%. They can get 9% for their investment somewhere else. We might have to do something to attract people to come to our bonds. So if our interest rate is low, sorry, I keep scrolling the screen, hitting that pad. You'll see terms like discount or premium mentioned in the chapter. All that means is that the bond might sell for less than, which would be a discount, or more than $1,000, depending on the going rate of interest in the rest of the world. I'm going to scroll down here till I get a little bit of space. That means what other people could find, what investors could find in the rest of the world.
Okay.
So if the rest of the world is offering 10%, and our bond promises 8%, nobody wants our bond. Yeah, it's not going to fit this. There we go.
So are these bonds
Our
issued
bond at
by?
a discount.
So are the bonds issued by financial institutions only?
No, companies sell bonds. You can find bonds from all
Okay.
kinds of manufacturers to retailers, usually run through a broker in the same way we don't buy a car directly from Ford. We actually go to a dealership who represents Ford or General Motors and acts as an intermediary. But we're going to kind of keep it simple in here and just pretend that we're going right directly to the company, getting their bond. So if the rest of the world was offering 6% interest and our bonds, and we printed them up at 8%, now we wish we hadn't, because we could have been issuing them at 6% and probably could have kept people interested, but we're promising this extra special great rate of interest. We're going to ask people to pay us even more for the bond, pay us a premium. When we have something that people really want, like tickets to the NCAA Final Fours, we had a discussion a couple of weeks ago in class. It wasn't that long ago those games were being played, and one of my students actually considered going. He was going to be down in that area in business. He looked up the price of tickets, and that made his decision not to go. But because they were such a hot commodity, the company could ask more for them, just like people who had tickets to sell from the NCAA games could ask more for them because there was such an appeal to people wanting to go to them. Where here, this is like having merchandise in our store that has the name of some band that nobody likes anymore. You can't get rid of the merchandise. Nobody wants it. So we have to do something to make the bond appealing to people again. And usually in a store with merchandise, that means put it on sale. Maybe if you drop the price, then it'll become appealing again to people.
Oh, so dropping or
Right.
theoretically, though, you'd want to go higher on your interest rate, right? They want to get more out of it.
Right, exactly. So here, let's just go with the case. And there's big calculated ways to come up with how much you charge, but I'm going to make up some numbers here and just say this. We're going to ask people, in this case, you can have my $1,000 bond. All you've got to do is pay me $850 now. But this will give you $80 interest payment checks every year and $1,000 back to you when the bond's done.
Okay.
That makes sense, guys?
Yep.
Okay. And the $1,100 bond, you're saying you can have my $1,000 bond, but you've got to pay $1,100 for it. And the appeal to the bondholder and why they'd even want to consider it is that they're going to get $80 checks every 6 months, where if they bought anybody else's bond, they would only be getting $60 checks. So they might be willing to consider it. But the effect of doing that to the bondholder is if you pay $80 and in return, if you pay $850 and in return you get $80 every year, some quick math, $80 divided by $850 means you earned a better rate of interest. We'll turn that into an interest rate, and you're looking at 9.4% interest. So you've in effect raised the interest rate without actually retyping anything on the bond and changing what you're going to pay them every 6 months or every year.
And all you did was lower your price on the bond.
Right. And so there's a big math calculation to lower it to exactly what you want to match the world's interest rate. You'd have to do some present value things about how many years they're going to get the $80 checks and all that, and it would help you generate the price. But what we're looking at is if they tell you a bond is selling for exactly $1,000, the fancy term for it is at par. It just means I'm going to sell it for the price that's marked on it. I'm not going to raise the price. I'm not going to lower the price. That bond is earning 8% interest. That's its cost of capital. Where the cost of capital here is 9.41. Okay. that make sense? This one's cost of capital is actually a little more complicated. Not much, though. So let's just kind of go with that. All your problems give you this. They don't make you figure it out.
So all we're trying to do is figure out how much it's going to cost the company for
Right.
these, to issue out these bonds.
Issue out the bonds or any other form of financing, any other way that they could drum up some money.
Okay. Because they're paying the interest rate off that bond annually or 6 months, whatever.
You can grab the 8% if they're selling them at the $1,000 or at par. But if they lower or raise the price, then you've got a little difference.
Okay.
If you go to, and I'm trying to get you a page number, it's at the end where your pages start to turn blue for the end of chapter homework problems. Looks like it's page 360 in my book. There's a review of all the formulas.
Nope. I think we have different books, maybe.
Okay.
361?
Sure. You see something called review of formulas, number 1, number 2, and so on?
Yep.
Okay.
Yep.
Number 1 is the thing we're talking about.
Okay.
They always make things look 10 times more confusing than they really have to be.
They're good at that.
Yeah. Let's take a look at how they come up with that. They first come up with the yield, which is what we did.
So we're calling that a yield,
Right.
not cost of
It
capital.
is the cost of capital too. Cost of debt. But
Okay.
this is before tax. So let's just change that to say before tax, and it'll make it fit in there a little better.
I think that's what confuses me as they keep changing terminology throughout the book.
Right.
And I don't know what is what.
I feel that
Yeah.
way sometimes when I talk with computer tech people. It's like, can you speak English, please? Right.
And be consistent so I know what you're talking about.
I have a friend who works in tech support. He's a former student many years ago, has gone on to be a tech support person, and he always posts the hilarious, fun conversation, the most crazy call he got of the day. Those can be real interesting. Sometimes I feel like maybe I would be the person that someone else is posting their conversation with me about.
Uh-huh.
Okay, the last thing you have to do is take and figure the taxes in it. So we have to figure the after tax. This one gets a little strange, but if you bear with me in the logic of it, when you borrow money as the company on debt, you have to pay interest. The interest actually goes on your tax return as a deduction. So it's something you look forward to on the tax return, because something more you can take off your taxes. Just like when you pay interest on your mortgage, you get to take it off your personal tax return.
The same thing.
Right, exactly. So it's actually a good thing to the company to have that interest. I mean, they wish they'd never had to borrow any money, but if they do, at least they can save it on their taxes. So it makes doing it this way cheaper. Just as if you could say, I could get a home equity loan to put on the new roof, or I could put it on my credit card. Well, if I get a home equity loan, I can put that interest on my taxes. If I get the credit card to pay for the roof, I can't save on my taxes.
Right, okay.
So it actually makes the cost of us borrowing money cheaper by whatever our tax rate is.
Okay, so you're showing that deduction against the interest rate then.
Right. So let's say our tax rate is 40%. We are going to end up, notice I use the opposite here. There's a fancy math word for the other. Like if it's 40%, this is 60%. If our tax rate was 35%, we'd be at 65%. Whatever makes 100.
Okay.
Because we still are going to end up having to pay the 60 or 65%. We saved 40 or 35% because our taxes helped us recoup that.
Mm-hmm.
So after tax is the before tax times that other part of the interest or tax rate. If you look at the formula in the textbook that we were talking about, that's exactly what they're saying. They're calling this up here Y. So if this is our Y, they're timesing it by 1 minus the tax rate. 1 minus 40% would be 60%. That make some kind of sense?
Mm-hmm.
Okay. Like I said, most of the time this is already done for us. At least this part. All the story problems in the homework I noticed already had this done.
Yeah, you emailed me on that actually, because I wasn't catching on to that portion of it.
Then the tax rate will be given, and you might have to find the after tax.
Okay.
So that's what we're going to do with cost of debt. Let's look at preferred stock is the next one. We'll go to a different sheet to kind of look at that.
Hey, Donna, before you go any further, would it be
Sure.
possible to get this Excel spreadsheet sent to us when we're
Yes,
done?
yes, definitely.
Okay. This
I will-
is a lot simpler than the book is trying to present it. So
I will try to put this in the email. Does that work when I send it out? Attached to the announcement, or?
the last one you sent me worked.
Okay. I usually have the link to the YouTube where this thing gets uploaded, the video, and then attach the Excel on it. But it'll also be in a section called the News Forum in the opening page of our course.
Okay.
It's kind of where the instructor's announcements go. But what happens is there's a button on that says email out this announcement to everybody. So I'm putting it in as an announcement, but I'm also asking it to immediately disseminate it through email. So you can look for both of those, hopefully within an hour or so after our meeting. These
Okay.
videos take a long time to download and upload. So that's my, my delay in getting it out to you. Okay, preferred stock. If I'm going to kind of give you a real brief overview. There's two kinds of stock, common and preferred. If a company only has one kind, it's common. Every company that's a corporation must have common stock. Preferred's a special kind that they can have that is similar to a bond or a note, but kind of like stock. It's like stock in the fact that it's not a legal debt of the business. Where a bond or a note, the company is obligated to pay that back. They've made a contract with you to pay that money back. Preferred stock is the stockholder investing in the company, knowing that they're risking their money and possibly could not see it back.
Okay.
The company makes the promise to pay them a dividend. And generally, that's almost a guaranteed dividend. We won't get into the funky rules of how they can and can't and maybe could not pay it back. It's much more guaranteed than a common stock, which is really a gamble whether you'll see a dividend. And there'll be a percentage on the stock that'll say every year we'll pay 5% of the par value as a dividend.
Okay, so the common stock is the one with the bigger risk, or the preferred stock?
Common is a bigger risk. Preferred stock goes on forever, so there's no limit to the life. I guess that's a good way to say it.
So when it comes to preferred stock, we're actually referring to something that we would see in reference to the Dow Jones or NASDAQ.
There's two classes, and so there would be a distinction in the letters. They even could have several kinds of common and several kinds of preferred.
Oh,
So
okay.
it'll indicate to you the company and then the kind of stock that company's issuing.
So those are actually common and preferred stock reflections of the company's current position then.
Right. But when you're reading the stock market, you're always looking at the used car market. You're looking at the price someone is selling to someone else of stock they already have from the company.
Okay.
The only time you're going to see the company issuing it directly to the stockholders is an IPO, the initial public offering of that kind of stock.
Right. Okay.
And then from then on, you're going to see it traded between people. Somebody's going to hold it for a long time. Somebody else is going to hold it for a short time and get rid of it.
Okay.
So when the company is promising or borrowing money through preferred stock, they're promising a dividend. The stock may or may not sell at a price higher or lower than its par value, but generally it sells at par. Now, what does that mean? It means whatever the par value is, it's not a set amount. Like a bond had $1,000 and that was always the denomination of all bonds.
Mm-hmm.
Mm-hmm.
These are whatever the company has decided. They're usually nice round things like $50, $100, but it can be whatever is decided. And then when you see the percentage up here, it's a percentage of that amount. So if the bond said it had 5% of the $100 par value, it means the dividend's going to be $50. Sorry, $5. Just getting generous with my decimal places here. And it might also say that it has 8% of its $50 par value. So you have to be careful. Don't look at just the percentage. Look at what the par value is. Does that make sense?
Yeah. Right now, I work for Perigo, and I'm sure everyone's seeing the offers coming in from Milan.
I don't get Paragon news except through students. What's going on?
Milan has made several offers now for Perigo.
Wow.
And I'm trying to figure out what they're considering the par value of the stock.
Preferred stock or common?
Well, they're going by a market share price, so I don't know.
The common probably has a very small, irrelevant par value. And common doesn't pay dividends on its par value. It pays dividends just based on the board of directors deciding, let's give everybody 50 cents a share or whatever rate. So par value is it's just not a real relevant thing in most decisions with common stock. So it may be something left out of most stories because it's so irrelevant.
Okay.
Market value is much more an indicator of the value of the stock.
Okay.
So when we're looking at the cost of capital for preferred stock, we really have to just look at the cost of the dividend that they're going to pay out. And I mean, I don't mean the percentage, I mean the dollar amount per share and the price. So we are going to look at what the price might be selling for. If it's selling above or below par, so that maybe the stock sells for $100, that may or may not be par amount. And the dividend that the stock offers to them is $5, then that cost of capital would be those two divided, or 5%. There are times when the price is not par. So if it's $95, then our cost of capital is going to be 5.2, 5.3%. The other thing that you'll notice in the formula, on the page of formulas, is they have one more thing in the bottom of the fraction. They'll say price minus flotation costs. Simple term that they give a fancy name to. It's a fee that their broker or their dealer makes the company pay So if the dealer sells the share of stock for $95, maybe the broker says, but I get $2 out of every one of those shares. So the company looks at it as only receiving $93.
Okay.
So they would do their calculation as a $5 dividend and a $93 share of stock, because that's all they received. So they receive $93, but have to in turn pay $5 back every year as a form of interest, even though it's called a dividend. It's really no different than the interest. That's going to raise the cost. It's now more expensive for the company. Their cost of capital just went up.
Because of the fees.
Right.
Okay.
There is no concern about after tax, before tax, anything like that, because none of this is tax deductible.
Okay.
So that's the worst it's going to get with preferred stock. The dividend, the price, you might have to figure in that service charge or flotation cost into the price and do the subtraction or the division.
Well, when we're talking about capital specifically, we are concerned about the interest because that does come off our taxes. When we're talking about preferred stocks,
right,
common stocks or preferred stocks, we're not concerned about any taxable interest.
Right.
Okay.
So these are the cost of capitals for preferred stock. And that's as much as you have to do with preferred.
Okay.
Common is the next formula they talk about. And with common stock, you're again taking the dividend and dividing by the price. But then after you do that, they add in a growth rate. If the dividend isn't supposed to stay steady, it's supposed to grow. Maybe the first year they expect the dividend to be so many dollars a share, but the company's going to get better and better. So every year they expect you're going to see a 2% growth from last year's dividend. Then you would have to add that into the calculation. So it'll tell you there's no way you could come up with a dividend by yourself. The company will have to tell you what they're paying in dividends. So maybe it's $3 a share on stock that you're selling for $80, and they expect it to grow by 2% every year. So you do the math and say, $3 divided by 80 gets you that percent. And let's make it look pretty so that back at your notes and remember what you're looking at. Add in the 2%. That was nice.
Yeah.
There we go. And their cost to capital would be 5.75.
You make it look very easy.
I know it.
Oh, remember, most of these are going to be given to you. What we're going to be looking at is how to kind of come up with an average, because the company's got all these different ways, and they probably do not all their borrowing in one method. The company's going to have borrowed some money through stock by issuing stock, borrowed some money on loans, and so it's looking for a balance. You can't say the company's cost of capital is this one number, because are you talking cost of capital through bonds or cost of capital through stock? And if you want to talk about one number for the whole company, you've got to average them. And that's what most of your homework has to do with.
Okay.
So what I want to do is go back now to the end of the chapter and actually look at a few of the homework type things.
Okay. 1 second, I'm gonna get a fresh copy.
I understand. Okay, if you'll turn to your first question, which is 11.3, and take a look at it. As soon as Matt comes back, we will get into the question.
Okay, sorry.
It's okay. This one actually kind of takes us back to prior chapters. It's trying to hit on a tiny topic to see the effects of interest rates on present value before it jumps into all these costs of capital. There's a lawsuit going on, and the person is killed, and they're trying to figure out how much to pay the family. They're basing it on what that family would have received if the person had lived and continued to work.
Okay.
The person could have earned $240,000 a year for the next 50 years. That's a lot of money that the family's now not going to bring in because that person's not alive. So the family's attorney says we should come up with what that would be worth today and give them a pile of money they could set in the bank, let it grow, and as it grows, take out $240,000 every year as if they were pulling out that person's salary, and that pile of money will last 50 years.
Oh, God.
But the lawyer on the other side, the plane or the pilot or whoever we're saying is to blame for this plane crash,
Mm-hmm.
they want to discount it or find the present value using 8%. What do you think that's going to do before we actually crunch any numbers? Which one's going to come up with a higher amount of money that is going to happen as the penalty in this lawsuit? The people who are using 4% or the people who are using 8%? Which one's going to end up with a higher settlement in the lawsuit?
Probably the 8%.
Yeah, wouldn't you think the higher interest rate would give you more money, right?
Except we're taking away that. We're going backwards, remember?
We're doing
Right.
present value.
The
Okay.
present value means that we're going to start out with all this money coming in sometime in the future, in this case, annually in the future, and bring it back to today by deducting the interest. So when you're deducting the interest,
Yep.
the 8% is going to end up with a lower
Right. Okay.
settlement.
So,
And
and
the
that's
4%
because the value of the dollar will be less in 50 years.
Yeah, let's take a look at it. If you do a present value calculation, and which way you've typically been using for present value calculations or time value of money, I like that one, calculator. So I am going to go out here to get that. Sorry. Changing your screen on you and trying to.
I couldn't find that same calculator we used last time, but
Okay.
I found something else that worked.
I couldn't find that particular one either, but I did find something else.
Yeah.
Here we go. Okay, I'm going to switch your screens on here.
Is that Dinkytown?
Yep.
I've been trying to use that one as well.
Okay. So are you able to see the Dinkytown screen here?
Yep.
It's dinkytown.net, DINKY town.net. That's the only thing I've typed in so far. And then there's a ton of choices up here. I choose finance. That gives me a bunch of finance calculators. And the second one down is basic financial calculator.
I just didn't know how to get to the right thing.
Then we can start putting in the information for our story problem.
That would have been so much easier.
Okay, let's put in what we know. 240,000 a year, wasn't it?
Yep.
Oh, and I probably want to make this negative. And payment. So I put it in as payment because it's going to be paid annually if the person had lived. So we're trying to look at the scenario of now how many times would it be paid? That's the N. So I put 50 and hit the N.
The trick is putting the numbers in first, right?
Putting them in the right way, the way it likes it. You can do these in any order. I could have just started with the interest rate. I'm going to do 8% first. So I've got the amount of money for how many years at 8%, and now I'm going to compute the present value. And it tells me that is basically $2 million, almost $3 million. Going back and typing it into our Excel so we can compare those numbers when we get both of them. And then doing it at 4%. So all I have to do in this story problem is just do a 4 interest rate. It'll replace the 8 and compute present value. Notice the differences?
Yeah.
That's all we do.
That's all you do.
Oh my gosh.
Okay. There's the textbook back, and we'll bring you guys back to the Excel.
Yeah, I did that totally wrong.
Well, now you have a good idea of how it can be done. And taking away 8% a year starts to mean you're taking away a lot of money to bring it back to the present. Taking away only 4% means you're not taking away as much, and it adds up to a lot of money. To kind of give you perspective, if we did $240,000 for 50 years, just straight up cash, without regard to discounting or anything like that, it's $12 million that person would be earning over their lifetime. And we're trying to bring that into an amount of money that would sit in the bank and grow to the same equivalent over time. If the person settling this lawsuit ends up receiving $5 million, in other words, they win and do the 4% discounting rate, they will have $5 million to put in the bank if they can find a 4% rate of return in whatever they stick the money in, a bank account, a mutual fund, wherever they stick the money. If they can earn a 4% rate of return, they will be able to take out $240,000 every year for the next 50 years, and that money will not run out until that very last withdrawal. The other hand, if the 8% people win the argument, the family's only going to receive $2.9 million. They will have to find an 8% investment to stick that money in order so that they can have $240,000 every year for 50 years. The likelihood of them finding that is by far not as good as the 4%.
Right.
So you can see the family arguing one way, and the company who has to write the check obviously would rather write the $2.9 million check than the $5 million check.
Okay.
So just choosing the discount rate changes the story a lot. But that's kind of the weird one out of the homework. The rest all kind of stay on the same topic. We're jumping all the way to 19 for homework. I want to kind of show you a few of these before we get there. 19, if you look at it with me for a minute, and then we'll go back and look at some sample ones so that I leave you something to do on your own. 19 tells you the cost of capital. The average after-tax cost of the debt is 6.5. So they've done the pre-tax multiplied by the tax rate minus 1 month's tax rate. They did all that stuff for us. They did the preferred stock calculation, and they did the common stock calculation. So they saved a whole lot of trouble.
That makes sense now that you've gone through it.
And now they tell you that their company borrows most of their money through common stock by selling common stock. 50% of all the money that they borrow or need comes in through common stock. Only a small percentage, only 15%, is through preferred stock, and the rest of it is through debt. So you're going to set up a really simple chart put these percentages in, put the cost of capital in the next column, and multiply and add up. So, let's see here. In our Excel spreadsheet, we're going to go debt, preferred stock, common stock, the percentages of 35%, 15, and 50. Plop in the cost of capital that they gave you. Sharon, did you have a question?
Oh no, I'm just writing this down.
Oh, sorry, and I'm putting these in without the correct decimals here. Let's do that so I don't end up with 650%. Oh, and it wants me to give it some more decimal places. Here we go. And this one is 10% if I remember. And 13.5. So, cost of capital. What do they call these?
Weights.
Yeah. Some profound like percentage of our financing or something, but yeah, you get the idea.
Okay.
And just multiply them.
Well, it looks like I might have done this right.
That's always a good sign. Carry our formula down, so they're all done that way, and I'm going to turn them into percents with a couple of decimal places. And the last step is to add them up.
We're just
I did it
multiplying by the 6.5, and then adding up our total.
Sharon, I missed part of your question, but you take the
Okay,
weight.
We're just multiplying our weight times our cost of capital, and then adding up our total.
Right.
Gotcha. Wow.
Okay.
So much easier.
Let's go find another one to play around with here and see if we can. Sorry.
I think the biggest struggle was understanding that the debt, preferred stock, and common equities were all forms of financing.
Yeah.
You know,
Some of it is just so much to take in.
It is.
it is.
So I'm trying to find one that's not your homework, that also doesn't add in 6 more steps that you really don't need to do in order to do homework.
Thank you.
That's a challenge. Okay, let's take a look at question 2. So it's right above question 3 that we were at a couple minutes ago. Okay, so this delivery company has debt financing and common stock. Doesn't look like they have a third because their weight kind of use that same format. Look at our cost of capital. The last sentence in the paragraph of the problem says that assumed debt and common equity each are 50% of the company's financing.
That's their.
Half their money in through debt financing and half through common stock. You can show these as percents or decimals. I just was easier to hit the decimal, so that's what I did. And the financing is up in the paragraph, the cost of capital. And make sure that you read and understand what's going on, because they're throwing a lot of percents at you. I see 11, 6, 9, and 15. And I only need 2, one for here and one for here.
Right.
We've got to kind of sort it out. They are looking at possibly buying a piece of equipment. They're going to finance it through debt financing, according to that first sentence. The debt financing is 6%.
Mm-hmm.
But the piece of equipment is going to bring them 11% return by making them able to produce more products. They can produce more products. They can sell more products. They can make bigger profit. It all kind of comes down to it does good stuff for them. If it can bring them back 11% better profits and only cost them 6% in interest, sounds like a great thing to do.
Mm-hmm.
And the 11% we're going to use in a couple minutes to evaluate the project, but it has nothing to do with our computation of the weighted average cost of capital. Then the next one says they're thinking about another machine that's only going to give them a 9% return. So it's going to increase their profits by 9% if they buy this new machine, but they'd have to issue stock in order to buy it, or that's what they're saying they would issue. And that's going to cost them 15% cost of capital for stock.
Okay, so common stock and common equity is the same thing.
Right. Equity is another way of saying stock.
Okay.
So we're going to do what we did before and multiply these. And then add them up. And their average, which if you remember averages, is since they're 50-50,
Yep.
do straight up average. 6 plus 15 makes 21. Half of 21 is 10.5. So their weighted average cost of capital, you'll see that abbreviated WACC, is 10.5. And what they're trying to show you here is evaluate the projects or the possible things you could buy using the weighted average cost of capital. That might change your mind about which projects to do. In this case, I would still do the initial project, the 11% return on that piece of equipment, and I would reject the new machine that was only going to give you a 9% return. But sometimes you can really change your mind once you average things out. It may make you reevaluate a decision on one of those pieces of equipment that kind of looked like a bad deal. All of a sudden, looks like a not so bad deal.
Okay.
So there's really two components in the chapter. One is doing all the math to get to this weighted average cost of capital. And the other is using that weighted average cost of capital to make decisions. Should we this? Should we this? Should we not involve ourselves with that project? Is this project better than that project? Okay. So this is the average. They say you borrowing money in your company costs about 10.5%. Whatever thing you get involved with, better raise your profits by at least that much. So that sets the floor or the minimum that you're willing to accept on a project.
And the company sets that bar.
Well, the average cost of capital sets that bar.
Oh, it does. Okay.
So what we just calculated.
Okay, so now looking at this problem, what am I comparing it to? So
You're going to go back up into those two sentences that said, like the first one, they can buy a piece of equipment that's going to give them an 11% return.
Okay.
So you're thinking, okay, do I buy this piece of equipment? Don't I? Well, my average cost of capital is 10.5%. This is going to bring me better than that. So yeah, I should do that one.
Gotcha. Okay.
Okay. The second one is only going to give you a 9% return. So you're better to say no to that one.
Well, I thought 11% had to be met or exceeded to justify the...
Now it's saying that this project's going to give you 11%, and we need to make sure we exceed what it costs us to borrow the money to buy the machine.
Gotcha.
Whoa. Now I get it.
Good.
Now I get it.
It's not quite computing yet.
Okay. You've got two ways to possibly raise some money. And it looks like, honestly, if you're going to buy a new piece of equipment, you can kind of say half of the money from the piece of equipment is going to come in through debt and half of it's going to come in through selling stock.
Yep.
Combined, it's kind of cheap to issue stock or bonds, but a little more expensive to issue stock. You merge the two together, you're looking at an average of 10.5%. It's going to cost us that much to borrow. Whatever I do, buying a new machine or whatever, better give me at least that much in extra profits.
Okay. So being that percentage is below the 11%, we're good.
Right.
Okay.
This yellow part here, this weighted average cost of capital, sets the floor. Every project we will accept better be better than that.
Better be below that rate. Okay.
No, be above that rate.
Above it.
Right.
Above it.
Right.
So the 11% is above it, but the 9% return is below it, so we wouldn't accept that project.
Exactly correct, Chad.
Okay.
Matt, did we just twist you around again?
The 10.5% is below.
Because it's going to cost us more to purchase the equipment than we're going to get a return on.
Right. The
Okay.
second piece of equipment is not worth doing.
Okay, well, so
If we buy the second piece of equipment, we
Yep.
could say that it was going to cost us averaging 10.5, and that second piece of equipment only promised to give us a 9% better net income or profit. So we'd be spending 10.5% to get 9%.
So, yeah, essentially you're losing 1.5% by making that investment.
okay, I guess my confusion is if we're saying 11%.
That's the one I would accept, because
Okay.
that is going to raise your profits by 11% and cost you 10.5 to borrow the money to get into that project.
Okay, I'm hearing it now. I'm seeing it now.
Okay. Hopefully those greater than, less than signs will help, especially if you have to come back to looking at this later.
Yeah, that does help. I'm trying to make sense of it as far as the calculations go and what the information's given, though.
Well, the information given is telling us that if we buy this first part, it's going to project that we're going to make 11% off of our original, off of what we originally put in, right?
Yes.
And then, but it's telling us we have to make at least 10 and a half. This is telling us we're going to make 11, so that's going to give us a profit. But if we do the second part, we're only going to get 9%, which is less than what we would have made originally, which is the 10.5.
Sorry, I keep changing your screen probably on you. I'm trying to open something here and it's not wanting to open for me.
Talk through it, Matt. What's not making sense?
Okay. Yeah, I apologize. This isn't.
No, that's okay.
Yeah, we want you to understand for sure.
It may take you doing some more of the homework problems and then coming back to it. And, we can set up a time to kind of walk through a couple more. It may mean that chapter 12 is going to sink it all in for you, because 12 is a continuation. So as we talk about 12, that may make something all of a sudden make sense.
Well, Matt, I think where your confusion is coming in, because when we were talking before, we were saying that the higher number is actually not is less.
Well, I'm not sure where this chart actually represents the 11% and the 9% or the 6%.
They don't. We are going to then use those to compare to what we have here. There is nothing in our weighted average cost of capital calculation that involves that 9 or 11.
Okay.
I completely ignored them because they're the other side of the story. what we're doing in this calculation in this chart is just trying to figure out how much it's going to cost us to borrow the money. We get all that done, come up with this calculation, then we can say, and what is that project going to do for me? And is it worth doing that project if it's going to cost me this 10.5% interest? Okay. Well, I want to take you into the next chapter, and we will come back to this if this is still.
Okay. Sounds good.
Okay. Chapter 12, and let me just take a second and get you a page number. 384. We are going to be looking at projects and trying to tell what their rate of return was. Do you remember in that problem we just looked at? We said it gave us an 11% return, gave us a 9% return. And I turned that into, it's going to raise our profits by a certain amount. Kind of put it in some kind of plain English. We're
Okay.
going to be looking more specifically at what a project's going to do for us. So I want you looking at the table that they presented there, and I'll be looking at the paragraph up above it. The company's considering buying a new machine, a new piece of equipment. The company said that they have a $50,000 piece of new equipment. They're going to depreciate it $5,000 every year. The company makes $20,000 in profits before taxes are taken out and before they take away any depreciation on their income statement. They take away the depreciation on the new machine because this is something that would now be on their financial statements. If they buy a new machine, they're going to end up putting on more expenses on their income statement. They're going to put on the depreciation expense. Depreciation takes your profits down, which means your taxes aren't going to be as much as they would have been. So you'll have earnings after taxes of that light blue $9,750. That's what the profits will be if they accept this new machine. But there's two more lines listed on this chart, and I'm going to kind of help you see why they added those two at the bottom. So the additional profits reported on the income statement, $9,750, that may be higher or less than it would have been had they not had this new machine. Depreciation definitely takes the profits down, but it could very well be that the new machine helped us make more products, so therefore we can sell more products, so it might have raised our revenues. But when we're all said and done, the profits are $9,750 with the new machine. But some of our calculations are going to be looking at the amount of cash that came into our checking account this year. What was the cash flow this year after buying the machine? Depreciation doesn't take away our cash. So while it took away some of our profits by being an expense on the income statement, it didn't hurt our cash. So we're going to add it back and say, what would the profits have been if depreciation had never been taken off the income statement?
Okay.
They would have been $14,750. So this chart's trying to show you that profits are different than the amount of cash flow. And a lot of our stories are going to look at cash flow in this chapter. The first thing is just understanding how to get to cash flow if all they give you is profits. You want to add back the depreciation.
Gotcha.
Okay.
Okay, then what we're going to do is evaluate some possible scenarios, things we can get into and decide if they're good decisions. Should we buy this piece of equipment? Shouldn't we? You know, those kind of decisions. So if you go with me now to 385, methods of ranking investment proposals. You'll see investment A and investment B. Usually in these scenarios, they're trying to decide which one they should do. Sometimes they're both good things to do, but one might be better than the other. And according to this, these little timeline looking things, you see how in point 0 they have negative $10,000 in both projects.
Mhm.
What that's saying is that both investments cause you today. 0 is always now or today.
Present value.
Right. You have to spend $10,000 for either one of these. So they're both $10,000 scenarios.
Okay.
Okay.
Investment A promises to give you back 5,000, 5,000, and 2,000 stretched over the next 3 years. That's what it's going to increase your checking account. Cash flow back to you. That's why it's positive. So you're going to get a total of $12,000 back from that project. Investment B, you spend the same amount of money and you get back over 5 years, 1,500, 2,000, 2,500, 5,000, and 5,000. So you're going to get back more than 12,000. It looks like 16,000 if I've added it up right. And they're trying to decide which one's a better one to get involved with. Do you just look at how much money you get back? Well, you know from present value chapters and all that stuff that you got to think about when you're getting the money too. In investment B, after 3 years, you would have only gotten back $6,000. Because
Right.
early years, you don't get too much money back. You get your real money in year 5 and 4 and 5.
Right.
Where in investment A, you get most of your money in year 1 and year 2. So that's nice. You get your money back faster.
Mm-hmm.
But there's something that should be said about the fact that it does give you more money in investment B. So what I'm trying to show you is there's just a lot here to consider. There's no clear-cut winner from just that little bit of information. We're going to apply 3 different ways, and that stretches onto the next page. You will see them talking about 3 widely used methods of evaluating these decisions or helping you make the decision. One of them is called the payback method. Internal rate of return is another one, and net present value is the third. And they each have their strengths and weaknesses, so there'll probably be some discussion in the chapter of how to do the method, but then also why this method's good and why it's not the best.
So it could be
Some of the
the
other-
company could use one of those 3 ways then, not necessarily all 3 of them.
You can use just one,
Okay.
just kind of understanding that there are some weaknesses to each one individually, but there's also increasing level of complexity.
Okay.
So payback method's benefit is that it's simple.
That's me.
The drawbacks are that it doesn't tell the whole story. And
Who needs a story?
I'll explain the reasoning behind that in a minute, but let's look at payback method. It's really asking how long before I get my money back. Yes, I'll put a question mark on the end of that. So let's look at investment A. I have to spend $10,000, but it's only going to take me 2 years. In 24 months, 2 years, I can have all my $10,000 back.
Mm-hmm.
So investment A is 2 years. But investment B could take a while. I said after 3 years, we're only at 6,000. So we're into almost 4 full years. Be something like 3 and 3.75 years, something like that. That makes sense?
Mm-hmm.
After 3 years, I only have $4,000 left. Or sorry, $6,000. So I need 4 more thousand. So I think it works out to 0.8. And I'll show you how to actually specifically do that. You're going to look at each year. So I'll say 3 years gives me $6,000. In the next 1 year, I need 4,000 of the $5,000 that I'm going to get that year. So I do the division, and that gives me 0.8 of that year. So I need the first 3 years plus 0.8 of the last year.
Okay.
Make sense?
Yep.
So you got a clear-cut winner here. Payback says investment A is the way to go.
Right.
Now here's the drawback. Investment B is going to give me more money.
Right.
If I just stick it out, I will end up, and maybe it would continue on beyond these years. It doesn't tell us, so I'm going to kind of assume this is everything, and we're probably trashing it after the end of the 5th year. But payback never looks beyond the point at which you have reached payback. It ignores anything else in the chart that goes beyond that. So while there might be great inflows in year 7, you would never see that with payback.
You're just looking to get your money back off the investment.
Right. How quickly can I get my money back?
Okay.
So good, simple method to do. Unfortunately, doesn't tell you the whole story.
Investment A is me because I like a quick payback. Investment B is my brother because he's got money to invest.
Right. And he can live without it.
He's older.
Okay, internal rate of return says let's compare what we're getting to what we spent and figure out what rate of return we're getting on our money. You can go through math with it, or you can find a calculator that'll do it for you. And so, did I do these out of order? That's
No, number 2.
It's number 2, but the book gives us net present value first.
Yeah, the book is very confusing.
Oh, okay. I'm just going to follow their story. Let's do net present value because you need net present value to do internal rate of return, or they're very tied together. So, as you can imagine, you're going to need present value calculations to do this one. Net present value is finding the present value of all the money you will get. Then I'm going to make a number up. Let's say I go through all that present value calculation and it says that my investment's going to bring me $10,235. That's the present value of all the money I'm going to get. I don't want anybody looking at this later going, I did all the present value calculations on that problem and I can't get that number. Okay, so it says that the present value of our investment brought back, we're going to have to know some kind of interest rate to put it in all the present value calculations. And I'd have to go through investment A and bring all 3 of those numbers back. Investment B, bring all 5 of those numbers back to today. But when I add them all up, they got that. Then I'd have to compare that to for an investment. What I had to pay to get involved in the investment. And that was $10,000.
Correct.
So then I find the difference. Trying to put it in somehow a decent language. If you get more money back than you had to spend to get the investment, even if it's just $1, this method would say that investment is worth doing.
At present value, not over.
Right, the present value of what you get back. So we don't know the present value of A or B yet until we go through the calculations.
Okay.
But that's the theory behind it. Now, what we need is we need to know what interest rate to use. Because when you do present value calculations, you got to put in the number of periods, but you also have to put in an interest rate. What you use there is the company's cost of capital or their required rate of return. That's what you use. The company's going to want a number. I want projects to give me at least a rate of return of this. They have some number. It's probably based on their cost of capital, but the problem will tell you the company's required rate of return is, and they'll give you a percentage. That's what you use in the present value calculation. When a project comes out better than your initial investment, like we did in our scenario up here, that is saying this project exceeds the minimum rate of return. So whatever rate of return, we don't know the rate of return we're getting on this project, but we do know that it's better than our minimum or our required amount. Doing okay with that thought?
Yes.
Yep.
Okay.
I believe so.
So let's go see if we can actually apply it to investment A and investment B and make it a little easier for ourselves. We're going to go to that calculator again. Or another calculator. I'd set one up earlier, a net present value calculator that I found. It's already set up to do exactly what we want. You can do it with the Dinky Town one too. But this one's just so nice. It gives you the net present value calculator. You want to make sure, of course, that all your numbers are cleared out before you start putting things in. Okay. For investment A, we are going to have 3 times the money's going to be paid back, and they're not the same amount every time. So I told the calculator to give me 3 lines of information. I need to know how often it's going to be compounded. We're just going to do it annually. It didn't do it monthly or anything like that. So once a year. The cash flow at the beginning needs to be put in as what we're going to spend, and it needs to be put in as a negative, because we're spending $10,000 in the beginning. Year 1, we're supposed to get $5,000 back. Year 2, $5,000. I'll explain those little ones in a minute. And year 2 or 3, $2,000. And what was the interest rate? I have to turn away from my book to get this calculator, so someone could look up what they tell us in the story problem in the textbook for a required rate of return.
It says that at the end that assuming the cost of capital or discount rate of 10%.
Okay, so let's use 10%. I type that in and I'm going to calculate. And it tells us that our net present value is $180.32. That is not the present value of our investment. That is after they took away the $10,000. So their present value when they did all the work must have been $10,180.32, which when they compared it to what we had to spend to get the investment, this is $180.32 better than what we spent.
That's not very much profit there.
But remember, that's just how much it is better than 10%.
Oh, okay.
If this had come out exactly 0, then we would know this investment exactly gives us a 10% rate of return.
Okay, gotcha.
So we're better than 10%.
Okay.
And that makes it an acceptable thing to do. If we type in the other investment, again using 10%, this time we're going to need 5 years,
Mm-hmm.
and our returns were, someone would help me out here again, I don't have the book out,
1,500,
1,500,
2,000, 2,500.
then it was 5,000 to 5,000, right?
5,000 and 5,000.
Okay, there's two ways we could do those last two. I could have typed a 2 here in line 4 and said 5,000. That would mean 2 years of 5,000.
Gotcha.
Or I could do a 1 and a 1. Either way, give me the exact same answer. Everything else is the same, the initial investment and the discount rate, so I can calculate. And this one's cash flow ends up a whole lot better. And that's the difference in present value.
A big difference.
So this represents 1,400 on top of the 10%.
Right. So
Right.
this company is earning better than 10%, a lot better than 10%, where
Okay.
our first one was slightly better than 10%.
So they're both good investments. It's just a matter of if you can, if your business can sustain over 5 years versus 3 years.
Right?
Mm-hmm.
And a couple things to look at.
Good way to put it.
I don't think we were told whether it's mutually exclusive, meaning I only need one new machine. Should it be A or should it be B?
Gotcha.
But if I can possibly do investment A and investment B because they're totally different things, and I've got the money to afford to spend 10,000 on that one and 10,000 on this other one, I should do both. They both meet my criteria for good investments.
Mm-hmm.
Well, they're both past the test, just one by better than the other.
So if this came out, if the NPV came out to a negative number, then we know that it's below the 10%.
Right.
Okay.
Exactly. And this is kind of the same comparison we were doing on that problem you were hung up on.
Okay.
Our 10.5% was our minimum rate of return.
Okay, now I get it.
Okay. And these are earning better than that. So that one that was earning 11% was acceptable.
Okay.
And the one that was earning 9% would have come out with a negative net present value if we'd done all this on it.
I think this makes more sense visually.
I was thinking maybe these two would gel together for you and help you understand the other one. Okay, so the drawback on net present value, it's good. It tells us a lot of stuff, but the bad is we don't know the actual rate of return. And I'm back
Now
here.
I'm using the website you gave me earlier in the week, Calcu.
Calculator soup,
Yeah.
that's where this one's at.
Well, no, this one says CALKOO.
Oh, okay. That I probably gave you for internal rate of return, right?
Yeah, and I'm using the NPV off that one,
Well, that's fine. There's lots of them out there.
and it's giving me a negative 1414.
Did you type in the initial $10,000 that you spent as negative?
Yes. It's still showing a negative 1414. I'm thinking that might have messed up some of my equations.
Okay, let's see if, let me go there with you. So I remember when I do the, there we go.
I've got 10% for 5 years, and I put in the numbers, and then my initial cash investment was negative 10,000. And then it shows it as
I meant the website. Are you able to see this?
Yeah.
This happens to be the internal rate of return calculator, but I'll go to the net present value calculator. And I put in my $10,000.
Yep.
Now, when I typed it in, I typed it as positive. It turned negative.
Okay.
If you typed yours as negative, did it turn positive?
I typed mine as negative.
Check these other columns.
And I was, right. Well, okay. So I was putting it in as a negative. Should have been put in as a positive.
Well, it knows that most people don't remember to make it negative, so it self put it in there to help people out. But then people like you who knew to put it in as negative, it's doing worse things for you. This was set up very much like the one we just looked at, the 10% rate of return. You can put in the number of periods, so we can do the 5. And there's no cash going out in these other years, but there's cash coming in. And,
and I'm putting it in the wrong spot too.
Okay.
Okay.
1,500, 2,000, 2,500,
Yep.
and 5,000 and 5,000. And yes, then its present value comes out positive. I didn't even have to calculate. It was just keeping up with me every time I did it.
Okay. Now I know how to use it. Okay.
Each one's a little different, but they all are great. It's a whole lot better than doing it manually. You could do all these present value calculations, add them all up, compare them to the 10,000 spent, and you get the answer. You should be spending a lot of time doing it. We're going to look at internal rate of return, which does almost the exact same thing, except it actually tells you what your rate of return was, not just that it exceeded your minimum, but it will tell you what what rate you're earning. So on our investment A, $10,000, each year you're going to get 5,000, 5,000, and 2,000. And your rate of return that you actually earned was 11.2 or 11.1636%. And you can see that that's what we thought. We thought it was going to be more than our 10% minimum. We just didn't know how much more.
So if it drops to 9%, we don't want anything to do with it because we didn't meet our minimum.
And we would have known that by doing net present value. But if we didn't do net present value and we jumped right to this method, then yes, we have to do a manual look at this compared to our minimum, which was 10%.
Okay.
This calculator did not ask us for our 10%.
Right.
It just asked us for the cash. It calculates the rate of return and leaves it up to us to decide if we like that rate of return or if we don't.
So really, we should be using all 3 of these methods then.
And if each one sheds a little different picture on things for us.
Okay.
So would you use all 3 or just a combination? Well, would you use all 3 or maybe just 2 of them?
Net present value and internal rate of return are not going to steer you in different directions. The project that's good in one is going to be good in the other, or better in one is going to be the same better one in the other one. But it depends on what you want to know. I kind of like internal rate of return and payback just because it's super simple. But I would do internal rate of return before making the decisions, especially now that it's so much easier to do. Can you imagine these things before people had all these calculators to do stuff for them?
No.
Or Excel? You're doing all this by hand. That's why payback method and things like that were invented. They were just so much simpler when doing extreme calculations was so difficult. So do it for both projects or whatever your scenario looks at, and you can come up with all 3 of these for your various projects.
Okay.
So let's go back to the textbook and see where it was taking us in homework. Okay. The homework questions, chapter 12. Your first one is number 9. And you have to come up with a payback method. The top of page 412, if my book is marked right here.
Yep.
You have an amount that you have to invest in the opening sentence. And it looks like you're choosing between spending money on electric company or waterworks. Couldn't imagine where they got their. Oh, and you're the short line railroad company. Yeah, funny. I'm a Monopoly freak, so um, you have two different options. You can spend the same amount of money to get involved in the project, but with electric company, you're going to get money back every year for 10 years, but obviously different amounts of money. Years 4 through 10 are each in each project $10,000 every year for every one of those years. So the real difference is in these first 3 years, how the money is laid out. So look at payback, calculate it, decide which one's better, and then tell why payback isn't going to tell you the whole story. That's kind of what question.
What number are we looking at?
Say that again.
What number are we looking at?
I am looking at problem 9 of chapter 12.
Oh, okay. I was on problem 6, so I was a little lost.
Okay. So that's going to make you practice the payback method. Problem 12 is going to make you practice the internal rate of return.
Gotcha.
Question 14, net present value method. 15 is also net present value. And 18 is do both net present value and internal rate of return and decide which project you should do. You're going to keep applying these methods and then helping them decide which project to choose.
Gotcha. Okay.
Okay? Sound a little more manageable?
Yes, ma'am.
Okay.
I think so.
Get this recording saved and uploaded and send out links to all these calculators and everything.